Views regarding the economy, securities markets, or other specialized areas, like all predictors of future events, cannot be guaranteed to be accurate and may result in economic loss to the investor. Past performance is no guarantee of future performance. Any information is for illustrative purposes only and is not intended to serve as investment advice or as a recommendation, since the availability and effectiveness of any strategy is dependent upon your individual facts and circumstances. Individual securities discussed may be held in accounts where JGUA and or its employees have a beneficial interest. And with that, let's get to this week's episode.
Hey everybody, Dr. B here with John G. Ullman and Associates. This is our weekly market update for the week of May 19th. Thank you for joining us. We're glad you're here and we're glad you find these videos helpful and informative. Don't forget to like and subscribe to the channel when you get a chance. Also, if you have a minute, check out some of the other great content we have here on our channel. Now, with that said, my purpose for these videos is to use my background in economics to help you better understand the economy and the financial markets so you can make informed financial decisions. So with that said, let's get ready to hit the books and get up to speed on the markets. So as always, we're going to start by taking a look back at last week. So last week, we had some jobs and some inflation data, as well as consumer sentiment and just general economic information. Taking a look at the jobs, a lot of eyes and attention are on the labor market. One of the things that we've seen in recent weeks is the strength of the labor market, despite fear and concerns about the Trump administration tariffs. This week, or I should say last week, was no different. The weekly unemployment insurance claims and the weekly unemployment insurance claims continuing didn't change very much. They were both relatively flat. So although everyone's on the edge of their seat, waiting to see if the economy slows down and if unemployment picks up, we are certainly not seeing any indication so far. So last week, we saw the Consumer Price Index report for the month of April. We saw the headline Consumer Price Index increase by about 0.2% and 2.3% over the last year, which is actually the lowest level of inflation that we've seen since 2021. If we dig into the core values that exclude food and energy, we saw also about 0.2% increase, but the 12-month inflation rate is closer to 2.8%. Both of these are above the 2% target for the Federal Reserve, but relatively close. Taking a quick look at the producer side of prices, the Producer Price Index fell 0.5% in the month of April, although it increased 2.4% over the last 12 months. The single largest influence for this drop in producer prices was a 0.7% drop in the price of services. And the reason this is interesting is because a large portion of the services prices is actually measuring the profit margins of the products, meaning the difference between the price that they're sold for and the cost to purchase the product or the materials. So with that in mind, with shrinking service prices, what we're actually talking about is smaller margins or profit margins. And this could be the result of a variety of things, but it could involve lower prices being sold by the producers, but it could also involve higher costs, specifically tariff-related costs to the materials and the inputs going into that production. One last measure of inflation, we got data on the import and export prices last week, and we saw both imports and exports increase by about 0.1%. The interesting thing is when we break it down a little further, we see consumer good prices increased by 0.3%. We see that the non-fuel imports increased by 0.4%. And we see that finished capital goods increased by 0.6% in the month of April. So we can't necessarily read too much into these headline numbers, but what we can say pretty definitively is that foreign manufacturers are not discounting their prices as far as our import prices as a result of the tariffs, as has been suggested by some in the Trump administration. Switching over to consumer sentiment, we saw the preliminary consumer sentiment report for the month of May. And just as a note, we'll see the final result for consumer sentiment in about 2 weeks. So the preliminary result showed the 5th consecutive month of dropping or falling consumer sentiment. It also showed that we'd reached the second lowest level of consumer sentiment ever as far as this measure has been collected. Ultimately, we saw sentiment fall as related to personal income and future income, and we saw increasing inflation expectations, both in the short term, the next 12 months, and in the long term, more of a 3 to 5 year time span. There is one caveat to this. The majority of this survey was conducted before the China tariffs were paused, which I'll mention a little bit later. But it's possible that the pause in the Chinese tariffs and the temporary truce to the trade war with China could serve to increase sentiments slightly. What we will know is in 2 weeks, when we get the final data, that survey will include a healthy amount of responses after the China-US tariff trade pause. Also last week, we saw the regular monthly Treasury report. It gives us an idea of the federal government's budget, and in this case, budget deficit. Coming out of this report, we saw some interesting information. So for the month of April, the federal government ran a surplus of $260 billion, which is typical for the month of April, as the majority of folks, consumers and businesses, pay their taxes prior to the April 15th deadline. So in this year's April receipts, we saw an increase in individual income receipts by about 7%, and we saw a decrease in business revenue receipts of about 9%. In addition to this month of April report, we also got a year-to-date number, and we were able to see that the current budget deficit is just slightly over $1 trillion for this fiscal year. And compared to last year's budget deficit of about $850 billion, this year is significantly more. Taking a quick minute to look at some of our more broad economic data, we saw business inventories flat in the month of March, meaning very little change. We saw retail sales essentially flat for the month of April, meaning very little change. This is following a massive surge in March that most likely included a large amount of pre-tariff buying in order to avoid the additional costs. We also saw, as far as industrial production, a relatively flat value for the month of March, but this interesting flat value was made up of a significant drop in manufacturing production and a significant increase in utility output production. If we switch over one last piece, capacity utilization, meaning of all of our productive capacity, how much are we actually using currently? That amount dropped from the previous reporting period and is currently running slightly below its long-run average utilization. Taking a look at the housing market, last week the National Association of Home Builders released their monthly housing market index, and we saw the index drop pretty significantly. Some of the greatest concerns mentioned by respondents to the survey were, first and foremost, high interest rates, discouraging demand for new homes. Second of all, high tariffs, increasing the costs of materials and the construction cost for new homes by a significant amount. And third of all, a growing worker shortage that some have suggested could be the result of increased deportation efforts. Moving our attention over to the tail end of the first quarter 2025 earnings season, we saw earnings reports last week from John Deere parent company, Deere & Company, Walmart, and tech giant Cisco Systems. Cisco Systems reported better than expected earnings and revenues and put forward a pretty optimistic, strong forward guidance as to what they think 2025 will look like. Walmart beat on earnings but missed on revenues. And although they didn't change their forward guidance, they did explicitly mention the fact that the impact of tariffs is already being felt within their organization and their supply chains, and they expect to have to raise prices later this month, if not early in June, as a result of the existing and current tariff policies. Last of all, John Deere published their reports. They beat on earnings and revenue, but they discounted their future guidance significantly, and investors saw this as a negative sign for the remainder of 2025. Taking a look at the stock market, last week was actually a pretty good week for the stock market. We saw all three major stock indices perform well. The Dow Jones Industrial Average was up about 3%. The S&P 500 was up about 5%, and the Nasdaq ended the week up about 7%. At this point, the S&P 500 has essentially eliminated all of the losses for 2025 and is back to where it was to start the year. Ultimately, what we see in the market right now is an elimination of what we thought of as the risk premium in stock prices, as well as a return to less volatility and more normal trading levels, with the volatility index, or the VIX, floating around below the 20-point threshold. Ultimately, what the markets seem to be indicating is that the environment is more risk-favoring. There is some belief that either the Trump administration will eliminate or minimize tariffs moving forwards, or that the Trump administration is right and the impact of those tariffs will be much less significant than originally thought. At this point, we're moving forwards with quite a few unknowns. We still have a lot of lagging economic data to receive, but the markets seem to be optimistic. Looking over at the fixed income side, the yield on the 10-year Treasury rose and fell throughout the week, ultimately breaching the 4.5% mark around the middle of the week, and then falling later in the week back to about 4.43%. Bitcoin was relatively stable throughout the week, some little ups and little downs, but ultimately ending the week around 104,000, which is approximately where it had started. Earlier, I mentioned that there was a truce, or at least a temporary pause, in the trade war between China and the United States. Ultimately, on Monday, the Trump administration announced that they were going to pause the massive 145% tariffs on China for approximately 90 days, meaning that pause will end around the second week of August. Ultimately, the tariff pause was a huge relief to markets. It was a large part of the reason why the stock markets performed well last week. It's also one of the reasons why we saw the price of oil increase by about 2.5% by the end of last week. We saw the value of the US dollar increase, ultimately ending the week flat, but we saw some big increases immediately following the pause of tariffs. And this 90-day pause in Chinese-American trade war also led to a decrease in the value of the price of gold. There were several reasons for this, but the optimism that was generated by the tariff pause and the potential for a reduction of aggression in the trade war led investors to be more optimistic, less risk averse, which meant a movement out of treasuries and out of gold. Turning our attention to this week and what's ahead, this will actually be one of the big weeks for earnings reports of retail and consumer-facing firms. So some of the major headliners for this week are Home Depot, Lowe's, Target, Best Buy, and Dollar Tree. Ultimately, the big question we're looking to answer this week is whether consumers have slowed their spending or started to pull back on either small or major purchases and their spending habits and patterns. We'll also be watching closely for the forward guidance and what these retail-facing organizations believe 2025 has in store. As far as economic data is concerned, this week will actually be relatively light. So early in the week, we'll see the leading economic indicators report, which helps to provide some insight on where the economy is and where we believe it will be heading in the near future. We'll also see our weekly unemployment insurance claims, which could give us some insight into the labor market, whether layoffs are starting to occur, and the extent of the economic slowdown. Last of all, this week we'll also see information on housing. We'll be able to look at housing starts and building permits, but we'll also be able to reflect on new and existing home sales. Turning our attention a little further out, of course, the ongoing question is tariffs, right? There's still a lot of uncertainty. And in fact, the 90-day pause on the liberation tariffs will end in the beginning of July. The 90-day pause on the massive China tariffs will end in the beginning of August. So ultimately, we find ourselves in a place where every economic report is being scrutinized, every piece of economic data and sentiment survey is being analyzed to see what consumers are doing, how businesses are behaving. And ultimately, everyone from consumers to businesses to the government is all looking for clarity as to how these major changes have impacted consumer behavior, business profitability, and the functioning of the U.S. economy in general. Ultimately, with everyone on the edge of their seat, waiting for some magical clarity on the future, it's possible that if some economic data or some economic reports start to provide that clarity, we could see a lot of decision-making happen very quickly as everyone's been waiting for a signal. So as always, I want to take a minute to thank you for joining us this week. I'm glad you keep coming back and checking out these videos, and I'm glad you find them helpful. We do our very best every week to go out and read the economic reports, study the data, and bring you the most important information in an easy-to-understand format. Ultimately, what we're trying to do is bring you what you need to know to make informed decisions and to stay up to speed on the markets. With that said, don't forget to come join us again next week. Check out some of our other great content here on the channel, and have a great week.
Thanks for watching. If you found this video helpful, give it a thumbs up and hit that subscribe button so you don't miss future updates. Looking for more insights like this? Head over to our website at jgua.com for additional resources. And if you'd like to talk about your personal financial goals, we'd love to help. Just click the Schedule a Meeting button highlighted on your screen to book your complimentary consultation. Thanks again for joining us. We'll see you in the next video.